Yes, the JOLTS data came in hot. Old news. It's January JOLTS data that literally just came out. Let's actually talk about the Fed. Hell. Let's start with the Federal Reserve. The Federal Reserve is widely now believed to potentially reintroduce a 50 basis point hike. In fact, one of the best people to kind of give us a little bit of a heads up on this is my favorite mouthpiece of the Wall Street Journal, Nick T. Nick T is so wonderful because he actually gave us a video this morning talking about exactly some of his thoughts. Let's look at his video. Let's comment on exactly that video. Remember, Nick T is the guy who works for the Wall Street Journal, and he's widely believed to be the guy who kind of gets a heads up of what the Fed is going to do before they do it. Now, right before the Fed meeting yesterday in Congress, Nick T warned that the Fed was likely to come out and talk about a higher terminal rate. And that's exactly what the Fed did. So when Nick T says something, we generally pay attention to him much like we pay attention to the Fed. After we listen to what Nick T says, we're going to jump on into what Kenny G has to say. Kenny G's got some nice things to say about the Fed as well. Actually, maybe not that nice, but we'll listen to both. So let's see if I can make this technology function, and let's listen in to Nick T.
Powell now sees what everybody else sees, which is that the market is priced in 50. And so this will be his opportunity to reset expectations if he wants to. But what he said yesterday was that the data is going to play an important role here, and he doesn't know what the payroll report is going to be Friday. We will get the JOLTS job openings survey today, and then, of course, the inflation report next week, retail sales. So there's still data that could make up their mind here. But what I thought was important yesterday was that Powell also pointed to the revisions. So it wasn't just the hot January data we got, but it was the revisions that changed the profile of what the economy looked like late last year, and it seems unlikely that that's going to change in the next batch of data. So the revisions seem important here.
Yeah, could not be more true. So I want to actually talk specifically about that before we talk Kenny G, because there's something important in this. First of all, the JOLTS data, the job opening and labor turnover survey that we're going to be getting today, in my opinion, don't get too excited about it. The reason you don't want to get too excited about it is because it's from January. The JOLTS data that's coming out now in March 8th, is actually relevant to January, not February. So there's a lag of an additional month in the JOLTS report. So I would expect that JOLTS report to be hot today, mostly because all of the January data has been pretty dang hot. So I wouldn't put too much weight on that. Instead, one thing that I found that was very interesting about Nick T's comment here was that Jerome Powell was paying attention to the revisions. Now, not only is he paying attention to the revisions of the end of last year, which the revisions of end of last year were bad, right? They ended up telling us that, oh no, inflation was worse than expected. That's not great, right? We thought inflation was a certain level of low, and that actually worsened in the fourth quarter more so than we thought that it would, right? That's not ideal. We generally don't want to hear that inflation is revising into a worse direction, right? We don't want that. Now, what's interesting, though, is if Jerome Powell is paying attention to the revisions, what it actually means is the January revisions from the February data could be especially important. Now, that's something that we've started talking about over the last few days. I've started warning when these reports start coming out. The Friday jobs report, which I'll be covering in 2 days, and the CPI report next week. We really want to pay attention to how much was January revised. That'll be critical. So we'll pay attention to that, but those are two important things to keep in mind. So the JOLTS, I personally kind of casting that aside, pay attention to revisions like Nick T says the Fed is paying attention to. Now, let's take a listen to Kenny G here. What does Kenny G tell us about the Federal Reserve? Let's listen in.
But then what's your take on what Jerome Powell said today, that the Fed was prepared to increase the pace of rate hikes and that the terminal rate is likely going to be higher than previously anticipated? A lot of people are reading that as a sign that they're going to go faster.
So he created space today to move by 50 basis points on the next hike. You know, they'd come into this year pretty clearly telegraphing that 25 basis points was going to be the per meeting rate hike for the early part of the year, and then in some sense, taking the foot off the brake and seeing where the economy lands. And in fairness to the Fed, the interest rate tool as a means of controlling inflation it's like having surgery with a dull knife. It is a really difficult tool to get the job done with.
Now, that's actually really interesting because remember yesterday when Jerome Powell was testifying before the Senate, today he'll testify before the House. Keep in mind that usually the purpose of these events is to get politicians who can then clip their hardcore questions for Powell, and Powell's just deflecting them. So generally, I don't pay much attention personally to the second day of Powell testifying because there's going to be the same answers as we got the day before, generally. Obviously, I'll pay attention to potential differences, but that's my expectation. But anyway, this idea about rates being a blunt policy instrument is something that Jerome Powell has himself said before. He says, look, the only tool we really have is changing interest rates to affect demand. But that's pretty blunt. It's pretty broad. It affects everything. It's not like a surgical tool like Kenny G here is reiterating. That creates some problems because we don't really know what the lag is of the Federal Reserve raising rates as much as they are. Not only do we not know what the lag is, but it makes you wonder, hey, wait a minute. What about quantitative tightening? Don't even go there. The Fed is almost arcanely lost when it comes to the impact of quantitative tightening. So we'll see, but let's keep going with Kenny G's comments here.
Because you hit the housing sector, you hit the manufacturing sector, you hit parts of the economy that have a very high sensitivity to interest rates. And you tend to leave the rest of the economy relatively untouched. So the Fed doesn't have as much impact with their tool as you might hope. And although they've raised rates considerably, it's not clear how long the lag effects are for the impact.
Bingo.
And once the impact starts to play out, how damaging that impact is. So they're in uncharted territory. It's a difficult place to be. If I could tell one thing to the chairman, I would tell him to say less. I would just write a message. We're going to put the inflation genie back in the bottle.
No, I don't know if I agree with that. I actually really have enjoyed the Federal Reserve's mandate of more communication. The reason for that is it creates substantially less uncertainty. Now, Kenny G basically got even more mega rich last year shorting the market. So last year was a fantastic opportunity for short sellers to short the market. That doesn't mean Kenny G is always a short seller, right? It just means he played the market very well. I mean, hats off to him. Fantastic job trading. But the problem is Jerome Powell saying less could potentially activate substantially more fears that this market is going to end up getting what I call Paul Volckered. And getting Paul Volckered, I think, is actually the worst case scenario fear for the markets. In fact, if you follow me on Twitter, you'll see the thesis that I posted yesterday, which I actually thought was very well thought out. See, I'm complimenting myself here. But anyway, you can see my thesis on Twitter and take a look at it here. So what I posted was the following. I wrote, my 2023 market thesis. The Fed's fight against inflation will take much longer than anyone expected. This puts upward pressure on Treasury yields and downward pressure on housing. However, the stock market most fears Paul Volcker, the punishment following an uncontrolled second explosion of inflation. Now, what's really important here is Jerome Powell regularly communicates to us the conditions of Paul Volcker. The conditions of Paul Volcker specifically are a wage price spiral and unanchored inflation expectations. By Jerome Powell continuously communicating those requirements of Paul Volcker to us as market participants can determine how close are we to trending towards Paul Volcker. And regularly we hear inflation expectations are anchored. There is no sign of a wage price spiral. In fact, there's less of a sign of a wage price spiral, right? And you know what's really also phenomenal is more and more now I'm actually seeing people talk about job loss rather than like all the benefits and perks of their job. Like the job loss era is really happening. Now I want to go back to that tweet, but I figure I'm going out and building on tangent over here, but that's okay because these are actually quite interesting. I have to give a shout out to this TikTok because it was absolutely hilarious. Now generally I don't like watching TikToks, but this one was great. Hold on, I'll play it for you.
Griff to you, okay? This is not my first recession, so I'm going to explain the Circuit City Griff to you, okay? If you're under 35, you don't know about this one, okay? There was a store, a national chain back in the day called Circuit City. It was just like Best Buy. It was basically the same store, but instead of their color being blue, their color was red. All right?
I will say one thing that was substantially different about Circuit City and Best Buy was Circuit City really paid extremely well for commissions. They did a phenomenal job for their employees, but it's probably one of the reasons they went bankrupt because their employee expense was so high. I personally have fond memories of actually going to Circuit City and then going to Best Buy. Like, we would go to both, my dad and I. That was right after eating at Quarter Deck in South Florida. Anyway, let's keep listening to this because this is actually really interesting. We're talking about the wage price spiral. So I know you might be thinking, what does Circuit City have to do with the wage price spiral? Watch, it's hilarious. This is a great argument, and I'll summarize part of it at the end here, but let's keep going.
It was called Circuit City. It went out of business one day. It went out of business. And it was right around the time of the Great Recession. So all of my friends had gaps in employment. They had all these other issues. And they were stuck in entry-level positions. They couldn't move up in anything. So what did they do? They all got together and they started covering each other's resumes that each of them had worked at different positions at Circuit City.
Covering means you put somebody else's, like your other colleague or your friend's phone number in as your HR reference or whatever, right? That's what he means by covering, because the company's bankrupt.
Did they ever actually work there? No. Have they been a busboy for the last 5 years? Yes. But now on paper, they were a floor manager at Circuit City. Boom. They got more money. Oh, actually, I was the director of procurement for Circuit City. Boom. Nobody could prove otherwise. There was no HR department to call. There was nothing you could verify this information against. Nothing. And the reason why I bring this up is because
Okay, then he talks about how inefficient HR obviously is at Twitter, and you could basically now say that you've worked at Twitter and you're just part of the 6,000 people who got laid off at Twitter, and maybe you could land yourself a better job. I think it's very interesting, but as Brandon Howard here says, this is basically fraud. It is. It's funny, but in some way, it's kind of showing the pain that employees are going through right now. Like, this is the second day in a row now that I'm sharing, imagine this, TikToks on YouTube of people complaining about how difficult it is to find a new job. And now basically it's so hard to find a new job, people are resorting to fraud to get a new job. What to me, what that actually sends is this signal that, yes, we do not have the conditions for the Paul Volcker wage price spiral. That's probably the most important condition of this market. And that's why I say I personally believe the stock market most fears Paul Volcker. It does not fear higher for longer. In fact, that's what I say here, the next line. Although, as long as we don't face a Fed rugging, I believe the stock market will basically look through higher for longer, is what I argue here. Therefore, absent a rapid and intense re-intensification of inflation or reanimation of inflation, I believe a volatile Nike swoosh recovery is ahead of us in stocks, with 2022 representing the down part of the swoosh, right? In English, slow gradual uptrend for pricing power stocks, slow gradual downtrend for real estate. Pricing power stocks are those that favor higher income individuals, higher income businesses, those with high free cash flow, some SaaS businesses included. Like, for example, look at Bill.com. They have negative net income, but insanely high free cash flow. Only once in a recession, with inflation averaging, note averaging, very important, not achieving, that's very different. See flexible average inflation targeting. I expect the Federal Reserve will fulfill basically a mission accomplished U-turn. This is only likely to happen once excess savings evaporate. Yes, the savings rate is lower today, but excess savings may give businesses and consumers spending power for another 3 to 12 months. Unfortunately, by the time a recession is confirmed, staples, industrials, commodities, and the Dixie are likely to suffer. That's my opinion, obviously, especially upon a Fed pivot as yields fall. Staples, which were stocks some fled to due to for safety, whatever. Coca-Cola, McDonald's, Costco, Walmart, Johnson & Johnson, Procter & Gamble, IMO are likely to suffer. Do not make the mistake, of course, of confusing a Fed pivot with a market correction. While it's possible that something breaks and the Fed will only pivot if something does break, in my opinion, the Fed will only pivot once they're convinced inflation is under control. And that is, after all, the pain point of this recession. This recession is being caused because inflation is out of control. So if inflation is under control, then the only reason for really forcing the recession goes away. That's the point. Now, I do still believe that staples in certain companies will suffer, whereas higher income individuals and businesses will succeed because they'll be able to spend through this recession longer. Apple, Nvidia, Trade Desk, Tesla, Taiwan Semiconductors, to some extent, some of the housing stocks, Enphase, SolarEdge. And of course, layoffs are now hitting those white-collar jobs, potentially more than blue-collar jobs. However, personally, I don't know that that's actually going to have a dramatic impact, because you're shaving off almost off the top of the tech sector, if you will. It's not like the entire tech sector is getting laid off. There's still a massive amount of investment going in. Of course, then I give some general rules like stay out of margin, and we'll likely look back in 7 years and wish we bought more now. Invest in the down cycle of the real estate cycle. Good idea. Consider using ETFs, blah, 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 blah. Anyway, so I tweeted this on Twitter, of course. So I recommend you follow me on Twitter. But the point of this is really to say I am a big believer that the Federal Reserve or the concern of the stock market today is a fear of Paul Volcker. And if the fear is Paul Volcker, then as long as we get more communication, we actually avoid Paul Volcker. And that's what Kenny G, I think, here is missing, is that telling Jerome Powell to communicate less is a problem, because what you're doing is you're actually enhancing the likelihood for something to break in markets, because you're not properly communicating the markets that we're not going into a Paul Volcker style scenario. If we are going into a Paul Volcker style scenario, I would like to know that as well, because then I will flip-flop and sell faster than a flip-flopper on YouTube. Anyway, let's keep going with what Kenny G says.
Bottle. We're going to do what it takes to make that happen, and we're going to raise rates consistently until we see very clear evidence that we put this behind us. Because every time they take the foot off the brake, or the market perceives they're taking the foot off the brake, and the job's not done, they make their work even harder. And at the same time, remember, they're impacting in a very, very harsh way a very small part of the economy. And that's really tough for those businesses that live in that part of the economy.
Yeah, so he's making this argument that, hey, if the Fed basically pumps the market, they're making their job harder. With the Fed affecting the stock market, at least according to economic literature, has little to do with what actually happens. What matters more is what happens in the bond market and with financial conditions, not so much the stock market. Housing market and bond market, those two have much more of an impact. Now, there's some good comments here that are worth talking about. So Daniel here, a member, writes 1.9 to 1 jobs available. So they may be proud to temporarily work at a lower paying job. Okay, so really when we make this argument about the jobs and labor turnover survey, which we will be getting today, by the way, of course, but again, for January data, 1.9 to 1 jobs available implies that the labor market has so many available jobs. The problem is we have a substantial mismatch of jobs, right? So, and I think that's what Daniel is alluding to here, is that, look, you may be skilled in tech, but now you have to go work in a restaurant just to be able to pay your bills because you signed up for a lease that's more expensive than what you can now afford, right? That's unfortunate. But I do think that the COVID pandemic has created such weird dislocations in the job market that it is true, you just don't have enough people to fill the jobs and the roles where we actually need them. I don't know that this is necessarily trying to say this is the tightest labor market ever, even though that is what Jerome Powell says. I think we just literally don't have people either willing or able to work in certain fields, especially in hospitality or healthcare. Healthcare is 900,000 jobs short of where they should be according to trend. So it's very, very interesting in my opinion. Someone else here writes, but higher for longer will affect EPS, hence lower multiples, lower market. Yeah, potentially. I think the multiples have already been priced in, but you're right. If you multiply a lower multiple by a lower EPS, you end up getting a lower stock price. However, I am personally under the impression, and this is just my opinion, that the bottom 38% of the Fibonacci retracement that we've seen for the NASDAQ and the SPY or whatever is actually representative of Paul Volcker fear. And it's really the top 60% that is representative of EPS fear and multiple compression fear. In October of last year, markets were actually legitimately worried that inflation was never going to go back down. Remember, we've had the luxury over the last 6 months of actually seeing inflation trend down, right? We did not have that luxury in October. That's really important. Somebody's asking if I have a comment on someone else's video, but I actually don't watch other people's videos to the extent that I'm capable of resisting. So I have no idea when somebody else makes a video about me. Most of the time it takes somebody else asking me about it. And then I'm also generally not very interested in looking. That's a psychological thing. And I also don't know why we're talking about that on sort of the Fed topic. But you know what? Let me put it this way. It's a lesson to everyone. The very first video that I made on YouTube that brought me from 12 subscribers to 1,000 subscribers, where I was talking about real estate in 2017, I talked about this concept of the toxicity of relativity, of comparing yourself to the opinions of others. And I warned myself, like the most dangerous thing is doing that in real estate and business and entrepreneurship. And it's even worse and more toxic on YouTube because YouTube is so easy to measure. Views, subscribers, growth rates. It's so toxic. But unfortunately, as I believe the Bible says, comparison is the thief of joy. Don't do it. And what I like to do is I like to purposely not watch other people's commentary in my space because I don't want to start rhyming like other people. I like to provide a very unique perspective. That's not to say I don't study all day long. Of course I do. But not other content creators. Oh God, no. Anyway, so when it comes to the Federal Reserve, I am very, very look, I hate to say, I don't want to sound, dare I say, like a clown who is always bullish, because I'm not always bullish. I think everybody who watches me knows when I turned bearish was the right time to turn bearish. I became bullish too early. I admit my fault. But the point is, no, if I see the conditions of going bearish, I'm going to flip very fast. But I don't see that. In fact, I think most of the Fed speak yesterday and today is really just clickbait. I mean, no shit, Jerome Powell. Sorry, I shouldn't say that because some people watch this with children. But really, if the data comes in hot, you're going to go 50? Duh. Right? But that's what we've been talking about that since before the Fed meeting. Well, I've been saying on the channel, look, I think the Fed would shoot themselves in the foot in terms of credibility. If they go 50, the data would have to be so ridiculously intensely high for them to go 50 that I don't think they're going to do it. In fact, it's hilarious. And I'm not trying to say JP Morgan's watching my videos and pat myself on the back. As much as I would like to be able to say that, I'm not going to say that. JP Morgan released a piece on exactly that just yesterday. And what they wrote was they're basically that. They're like, look, the Fed will confuse markets if they go 50. If they go 50, they will send such a confusing signal to markets that they have no control, that you could actually cause more damage to markets. Here it is. It was JP Morgan's chief investment officer, Bob Michel, two first names. If employment data is very strong, you've got 50 BP back on the table. But that's a pretty high hurdle once downshifted. If you go back to 50, it would be pretty confusing to the market. I hope they don't do it. They were willing to run a string of 25 BP increases. Exactly. It's like, just add another 25 BP, but don't confuse the market with a 50. I think that would be silly. Somebody here writes, somebody who's watching on Twitch says, data says 50 now. No, data says between now and May, 50 is in the bag, but that's 2 rate hikes, right? We are sitting at about 50-50 for a 50 in March. Boy, that sounds very confusing. Now you're saying futures leaning slightly 50. Okay, all right, that's a better clarification. Yes, they're teetering on the 50-50 level. Last night they were teetering towards 25 by about a 52% margin. Maybe they flipped a tiny little bit with futures this morning. Either way, I don't think it terribly matters. Let's wait for the data and we'll see that. But again, what we're hearing from the Fed here is very important. It's no Paul Volcker, but yes, it is a volatile path forward, and that's very, very important. 50-50 when it was just 15. You are correct. Yes, you are correct. Don't get me wrong. I'm not saying Mike Trades here is wrong. You're correct. We have substantially moved towards 50. But in a weird way, I actually think that could be bullish because think about it. I think the hurdle to go 50, much like what JPM says, is very, very high. So if the market's pricing in 50, give me a rally, baby. Give me a rally on the 25. So yes, the market is trying to price that in. My 2-week-old won't stop saying SH9T. Thanks, Kevin. 2-week-old. Congratulations. That's awesome, man. I want to have a baby. Dude, I don't have a baby anymore. Look, you have a 2-week-old. I know you're going through hell right now. Probably lack of sleep and all the crap that goes along with that. enjoy it, man. And like everybody always told me that when I had a 2-year-old. I didn't believe them. I'm like, come on, man. This is like, I got plenty of time looking at these like tiny hands and tiny feet and stuff. I have a 7-year-old and 5-year-old now, and I'm like, dude, I literally don't have a baby anymore. I'm like, I want babies. I want like 10 more babies. So we got to get to work, but I'm just house hacking so much that, I'm not fulfilling my duties here. Anyway, okay, we're gonna get off that now.